Good afternoon, everyone. Can you hear me okay? Great. Just to let you know, the 30% sale for our site, like Chart Patterns Mastery, includes the Chart Patterns Mastery. Also, you'll have to talk to support about it. You click on the 30% sale, you won't find me. So you need to call support about it. How many did a lot of the trades I showed you on Friday? So just to let you know, this was the result. So up, there you go, up $1,100 on ones and twos, 12 for 12. So not bad for a free class. So just keep that in mind in there. So not bad. So if you were participating on Tuesday with all those trades I put up there, you were basically 12 for 12. So keep that in mind. Not bad. So that's number one. Number two, why did I get out? I mean, why would I get out anything? And I got out because of the warning signs that I harped on Tuesday. So here's your warning signs. The bonds, well, we'll just go over it. And the reason I know I want to go over the dogs and what to buy in the dogs, no doubt about it. But I want you to see this also. And I want you to see the warning signs. This was all gone over on Tuesday, Monday, and Tuesday. I got to show you this. And I'm going to show you a bunch of charts in here as fast as I can. So, number one, election gap. Okay, let me show you with the actual non-24 hour. So, there's your election gap right here. So, I just want to show you this, and this is why I didn't just blindly buy calls. Now, if everything was a positive divergence, I would have just bought vertical call debit spreads or sold puts or bought calls. But because of this, now you might say, well, what does this have to do with the small stocks? What it has to do is the small stocks are less likely to have a massive pop if the NASDAQ pulls everything down. So just keep that in mind in here. And I want to post these for you. I can't do it in the restream room, unfortunately, but I want to show you this anyway. So here is your election gap. Just take right here. Right there. Now, this has nothing to do with any kind of like, oh, well, you don't like the administration. This has nothing to do with this. This has to do with correlated indexes. I went over this when I was on earlier in the week. So there's your election euphoria gap right in there. So I want to copy and paste that for you. And there's a reason for this. Like I said, that doesn't mean you have to fill the gap. So just keep that in mind. You don't have to fill the gap, but number one, 1980, Reaganomics, you filled the gap. Then you went down for 18 months because the bond market was getting hit. So what do you notice now? Look on the right. The bond market's getting hit. Yeah, it's not a coincidence, but this is what I want to show you. Like I said, this has nothing to do with any of my opinions about administrations or Powell or anything. Dow Jones Transports filling the election gap. So if enough indexes fill the gap, then why even the Russell has filled the gap? That's the futures. Actually, the index itself has. So let me just copy and paste this for you. What this means as you watch the markets really crunch, what this means to me, just Dow Jones Russell Transports. Now let's take another one. Dow Jones Industrials. And the reason I'm showing you this is if all these indexes have undercut the election gap, then the probability is so will the ones that haven't. Really easy, really easy. So, I mean, it's not easy trading, don't get me wrong. But what it means is the probability was the other ones are going to do it. Now, the problem is that some of these are undercutting even more. So there's your election gap. They're under it. So you got the Dow like under it. So maybe they go even lower, but I wanted to show you that. And that's why we had shorts on as well. So that's one thing. That's why when I show you long ideas, you just have to respect that you better have some shorts in place, which is what we did. So just keep that in mind. The other thing, what would make the market go up? The bonds? Well, the bonds were up 17. They're on their low. The Russell, it was up 28. It's on its low. The whole point is this. If on the left, the NASDAQ is getting pummeled, it's going to pull down the Russell, even if the Russell should go up. So just keep that in mind in here. The other thing, and I thought I'd show you this. So a lot of you don't know this. And like I said, I don't get promoted much about my experience, is I've been doing this 45 years. So I was on the floor when the VIX was created and when the SPX was created. I watched the pits being created. So I want to show you this because I watch 8 million people look at this wrong. What worked 45 years ago is still working now. So just to let you know, correlations matter. And I want to show you this. So this is the book. Those are the clerks that maintain orders back then. So these are the screens you're watching. I was in the IBM pit. I stood there for 8 years in the same spot. What are they watching here? They're watching news, but they're watching companion stocks. They're not watching the VIX. They don't even have the VIX up there. They're not watching the dollar. They don't have the dollar up there. They have stocks that would move the SPX and the QQQ. That's what they have up there. That's it. No more, no less. So go back to now. What is one of my strengths? It's identifying what traders are keen off of. What are they keen off of today? They're keen off the bond market. They're keen off the big stocks. The Apples, the Amazons, the Metas, the Google, the Tesla. Just keep in mind, that's a bear flag right here. I was gone, but there's a bear flag. This is why on Tuesday, we spent an hour going over historical precedents. So what are the historical precedents? The stocks that are the strongest at the end of the year see that? This is sort of amazing. Look at Apple on the left and Microsoft on the right. Those are daily charts. All right. Now look at them last year. Go to January 5th. January 5th, well, January 3rd's fine. That's Apple last year. I bet you're like, no, that's Apple this year. Looks exactly the same. Isn't that wild? That's why we were short Apple. So you got to combine things. So like I said, traders are keen off the bonds and they're keen off the big stocks. The stocks that were up the most last year and the last couple of months have a habit of going back to where they were December 1st. So just keep that in mind. Where are they? Voila. Guess what? They're at where they were December 1st. So what's the only difference between last year and this year? So let me go over that so you know what we're talking about. What's the difference between last year and this year? Well, last year in here, the bond market was actually going up. And Apple kept going. You're right. But what happened to the bond market last year? So the bond market last year went straight up at the beginning of the year. So the leaders got sold, no doubt about it. When this happens, when you get that positive divergence, it usually means the smaller stocks are going to kick in gear. But this big stocks that were bought all last year get nailed and continue to. But if the bonds stay up, so you have a positive divergence, then usually these stop at price support. So let's go and look. Let's put in January 18th. Yep, stop the price support. I'm telling you, on the way down, forget about this fib stuff. We're on the way down, worry about price support. Moving averages didn't matter. The only thing that mattered was price support. Animal spirits come into play. On the way up, sure, fib retracements work, moving averages work. They all, they work. You can see it on the bonds on the right. Look how they held that 20 moving average. But that's on the way up. Once it breaks, then price support is key. Price support's key. Like I said, with the bonds going up that much, sure, Apple's going to eventually rally, but it's probably going to rally from price support. So now fast forward to now, what's going down? Apple, Microsoft, they're all going down. But it's different than last year. What's different? The bond market has not had any bounce whatsoever. Look at that. So this time, I think every rally needs to be sold. That doesn't mean every stock's going down. The stocks that acted the worst last year have a habit of acting better. So I'll show you. So nobody answered, but did anybody take the trades that I posted ad nauseum? So you're going to see. Well, just go into that list I shared. December 24th longs. Well, DPZ we were long, CVX long, CRSP long, PZZA A long, STNG long, NTLA long. In fact, we were long them all. TripAdvisor we were long. Now you might say, well, I thought you were long Lam Research. We sure were, and we got out when the whole market, way before the market started selling off. So I'm just telling you, that's why we took our profits. We took our profits in puts. We took our profit in all of these. So, Rick, thanks for saying that. Isn't that amazing? All of them worked. How many is it? Well, I know how many it is. It was at least 12 for 12. So, on a free class, remember that. 12 for 12 on a free class. Well, I'll tell you right now, I guess it was worth the money. But no, that's not bad. So, not bad. And like I said, you might ask, why did you get out? Why on earth would you get out when you have everything going for you? Because I wanted to take a profit to start the year. Number one. Number two, yeah, $1,100. Yeah, profit and loss open, not bad. But profit and loss, 1,100 on ones and twos. Just keep that in mind. Ones and twos. So you didn't have to trade big, just had to be right a lot. So just keep that in mind. So in there, like I said, I didn't do CELH and Oxy, but yeah, those work too. In fact, what's ironic is I actually wanted Exxon and CVX to go down because they were at the middle strike. But boy, I'm just telling you, I had to take a profit in everything. If everything goes down, then everything I liked is going to go down with it. So keep that in mind. Now, that being said, though, there's going to be a benefit probably next week about buying. Now, like I said, I only use the VIX in one occasion, and that's if everything rallies and the VXX forms some kind of bull flag. But I want to go over that really quick. The VIX, the VIX is a hindsight indicator. I don't even look at it. The only time I look at the VIX is with the Bollinger Bands. Ask Adam about this. So the only time we use it is with the Bollinger Bands. So if you see the VIX over its upper Bollinger Band, I'll show you. There. And we could put the SPX on the right. And you're going to see on a daily chart that when the VIX gets over its Bollinger Band and closes under it, that's a buy signal for the SPX. Now, with the bond market on the low, you don't stay in the buy very long. In fact, this is where I showed the exit. Look at that. Overbought at resistance. But it worked temporarily. This one worked, this one worked, this one worked temporarily. But if the bond market is on the low, you have to be extremely careful about trying to ride this to like 6,100. So just keep that in mind in here. But that's the only time I use the VIX. The VXX is a double ETF. So it's an exchange traded note. Now, one thing you need to know about this, because it happened about 10 years ago. Does everybody know about the one VIX that expired? So what happened is this is an exchange traded note. So it's underwritten by a company. If all hell really breaks loose and that company goes under, this goes under with it. That's why an ETF is a lot safer than an ETN. Just keep that in mind in the long run. We watched one of them go to zero. So go to zero. But the reason I'm showing you this is if you look at this on a monthly chart, it's designed to go down. In 2019, it went to 5,000. It's now 40. It's designed to go lower. So if intraday you see it hold up, there's only two reasons. Number one, instability. Number two, an event is about to come out. So this has a habit of going up prior to the unemployment report, prior to the CPI, prior to the FOMC. But all things being equal, if it goes up before the whole market does, that's a good tell that the markets are going to sell off. Plus, you had other stuff like the bonds and all that. So, and like I said, this is all technical. That's all this is about. All technical. That's why I showed this earlier. And I kept saying this better hold. And keep in mind, I am not Chicken Little. Our 12 for 12 were long ideas. Then we had hedges. Those work too. But this is all about that. This better hold. I showed that much earlier. This better hold. And it didn't. Plus, the big stocks are going down, which pulled down the NASDAQ. Plus, the NASDAQ needs to go and fill that gap. So you have all these reasons. So, and also, Jack, I left for 40 minutes to go grocery shopping to help out everyone. My wife worked and my daughter worked for the government. So I left for 40 minutes. Of course, that made it go down. Plus, I was bragging about what I was up. So I just got out of everything. So, you know, it's sort of superstition. And I'll get in later again, but that better hold. And now let me show you another perspective. This better hold. This is the first time in a year that you've been able to draw defined trend lines. Defined trend lines. Just keep that in mind. So first time in a year. So, you know, just keep that in mind. So this better hold. You see the gap. Look at that gap. I'll put it in the NDX. So what's going to keep this from going to here? Well, if you see the bonds out of nowhere up like 30, yeah, that'll help. So just keep that in mind. Now, getting back to what stocks to buy. Well, you're going to see that a tremendous amount of the stocks I like, including XBI stocks, are acting fine today. The XBI underperformed last year as opposed to Apple. So the end of the year, I'm talking about December, it got pummeled. So theoretically, it could go back to where it was in December. So just put the XBI on the left and then go put Apple on the right. So theoretically, Apple could go to December, which it has, and this could go to December, which it hasn't yet. So that's why we were long a lot of biotechs and short Apple. And that brings me to another thing. Number one, like I said, I've been doing this a long time, and the things that worked 40 years ago are still working. So keep that in mind. That's number one. Number two in here, and I think this is important because this is something I think hardly anybody looks at. Let me see if I can share it with you. Let me see if I can share it. I got to try to find it, so just give me a second. That is rule, you'll see it, 10B for hyphen 18. So what does that say? That says that companies can't buy back stock the last 10 minutes, and they usually don't buy back near the opening print. That's why a lot of times you've seen the low in Apple near the opening. So that's number one. Number two in here, companies voluntarily don't buy back stock 5 weeks prior to earnings. Now you see 8 million people on internet, 8 million people on internet talking about, oh, Apple doesn't have a buyback, it's going to get hit. See all these times? It went up in the buyback blackout. All this means is bad news, which it had. Somebody downgraded iPhone sales, and a bad chart are more likely to work 35 days prior to earnings and in. As you see, bad. So what happened back here? Well, right here, Warren Buffett came out and said he was selling Apple right at the buyback blackout. Guess what? Had bad earnings and went straight up. That's because their buyback resumed. So it's all about a bad pattern is more likely to work if it's in the buyback blackout. Bad news is more likely to make a stock go down. That's all. No more, no less. So guess what? We came in short Apple. So what did we come in long? All these CRISPR stocks. Why? Because they closed near their low for the year and they were starting to turn back up. That's all. Now, why did we buy them on Tuesday? I mean, really on Monday, a lot of them. Because a lot of times they go up the day before. So you had CRISPR go up. You had NTLA go up. You had XBI go up. So now that doesn't mean to chase strength. But it does mean to look for the opportunities once there becomes positive divergence. So that's all it means. Once you see the positive divergence. What is the positive divergence now? There isn't any. So your first objective, number one, with the Dow down 328. So the Dow is here. No, it's filled the gap. That's the futures. You got to take the DIA. So it's filled the gap right there. Filled the gap. This better hold. If that doesn't hold, that undercuts, then why should the NEX only stop there? So now you can see this trend line even better. Look at that. So let me share that with you. Now, just so you know, and I'll go on a little longer if nobody else is on, just so you know. So don't think, I'm just going to cut you off. I'm not a moil. I'm not going to cut you off in here halfway. No way. But lots of times this breaks and then it gets oversold. It's all about the oversold rally. You can see it this morning. So you had that. You had the oversold rally. You can actually take the NASDAQ futures. There you go. So what did the first rally do? in here. It just went to resistance. These lines were posted before the opening. Prior support becomes resistance. Just keep that in mind. It becomes resistance. So where could it go? Well, I showed you where it could go theoretically. So if you don't see these bonds rally and this Russell rally, I don't know why I want to chase strength, but I do want to find opportunities on the long side later. So I'll show you on how I want to do it. Now, the first thing is really, I just take what I showed you on Tuesday in that free class I was on over 4 hours. So why did Domino's go up? Because pizza went up. Companion stocks and also the Super Bowl effect, like I warned you. So number two, why did Domino's go up? For a strange reason that I didn't know till this morning. Here's Domino's. Here's pizza. Which one acted better on Friday? Pizza did. I'll just answer it for you. So you see what pizza did. It went up. Domino's closed on its low. Why? Because Domino's voluntarily transferred their listing to the NASDAQ from the New York. So a lot of funds had to sell this on Friday. As you see, it closed on its absolute low. And then and we bought spreads to bet on it going up today. Now, we bet on it going up because of companion stock with pizza and the Super Bowl effect. But I didn't need to get out on the opening. Now, you might be like, why did you take your 30% profit on the opening? Because I was worried about the broad market. Because if the market's down enough, it's going to pull everything down. Look what DPZ has done in the last hour. It's gone down 8 points. So that's why we got out. Did I get out too early? Of course I did. But we made money, good money. 490 to 590 on the butterflies in there. So we're out of these things. So in fact, the only thing I'm in right now is this. So we still have that February on as a hedge. Remember, we did that for like 597. And now it's almost 7. So if you want, you could just get out. But with the Russell going down, yeah, if you don't have anything on, you could get out. Keep in mind that was a hedge. Right now it's 689. I mean, you're not talking about a 10-cent butterfly that goes to 15 cents. You're talking about a $5.97 butterfly going to 7. So you're talking about real money, big money. So that's why, we made money on 1s and 2s lots. It doesn't take a lot. I had a 3 lot of that. So you make $450, and the longs went up. So keep that in mind. But I'm telling you, this is the next thing I want to show you. If the bond market doesn't rally, then it's less, and the transports don't rally. See how low they are? I'll put it on a weekly. There. So if the transports don't rally, and the Dow doesn't rally, and the Russell doesn't rally, then I'm not going to go crazy buying dips. I will look for opportunities, but I have to wait for a positive divergence. So if I see the bonds up a couple of points and the ES down 50, and by the way, Don, if you're in here, what did I tell you the NASDAQ would do net, down 400 over 2 days? So it's down 400 over 2 days. I thought it might be on Tuesday, but it took an extra day. But there's your down 400. So why did I think down 400? Because that's the support. So that better hold. If that doesn't hold, you're talking about all the way to the election gap, all the way down here. So that's another 1,000 points. Just keep that in mind. So, like I said, I need to see more positive divergence But I'll show you some of the stocks I'm looking at. So I'm looking at the stocks that closed near their low, and the theory is they got pounded because people didn't want to be in them the last month, and they especially didn't want to be in the last day. And sure enough, it popped on the close on today. So there are a number of them that acted like that. So we can, like I said, we can go through these. Even Kaba closed on its low almost for the year and then popped up about 20% today. BORR, I told you about that last week. So I'm just telling you, there are going to be a number of them, even NVAX, the vaccine stocks. What did BPMC do? That went up. What do you notice though? The whole market went down so much, it stopped going up. That's the whole point. Do I think these could lead to the upside? Absolutely. But you better start seeing some positive divergence or you can't buy rallies. That's all I'm saying. You can't chase rallies. That's all. Look at that. So, Adam, I saw that also. In fact, instead of the VIX up here, you could definitely put the ADQD. There. In fact, you can do it this way. The only reason I didn't do that, Adam, is because last quarter, you kept having weak advanced decline and those MAG 7 kept pulling everything up. But let's go and we're going to put this up and then I'm going to go over some stocks, no doubt. So here's ADD on a 1 minute chart. Like I said, don't look at the VIX. That's a lagging indicator. There's your advanced decline on the left. On the right is going to be the SPX. So there's your SPX. When did the SPX start going down? Well, it tried to have a new high right here at noon. And at noon, this was already this far from its highs. So now there's sometimes it's even more dramatic where this will be on the high and this will be on the low. But yeah, that was a good tell also, which makes you wonder now where this refuses to go lower. Well, I mean, this is still going down. It's still up for the day, but it's not bouncing. So this just bounced about 7 points. This went down, not up. So there's still too many warning signs for me to chase anything. So I just want to make that clear. So right now, I don't have a lot on. It's not a pretty sight. So I'm glad I don't have the camera on. No, just kidding, just kidding. But I have very little on. I have on the XSP and I've been completely transparent about all the trades we've done. Just keep that in mind, trying to be completely transparent. And I'm not going long. I'm not going long till I see positive divergences. If I see this, I'll be happy to do it. Let me show you. So I'll show you what we're talking about. If I see this, this happened last year. Now, there were 2 ways you knew the market would go up last year. So one of them is the bonds started going up last year, not this year. See that bond market rally? The other is I did a class on the art of short selling. Yeah, right at the bottom. So I begged him not to do it then because historically that's a strong time. But when the bond, look what happened here, because it's a great question on your part. This was in the Restream room. This started going up before this did. And that's one reason that the overall markets went up. You started to get positive divergence. So what happens? A lot of times this is what happens. Some kind of news comes out. You know, bonds go up 30 like a point. You know, whether it's the terrorism stuff, whether it's anything like that. And this has a mind of its own and gets slammed. Then you got yourself some positive divergence. So you don't have it now. You actually got it in July. So I'll just show you. And then I'll go over stocks. But like I said, I don't see the reason to be desperate buying stocks when the Russell's on the low and the bonds won't rally. But let's just show you so you know what we're talking about. So last July, so you had the yen messing around with everything. So where everybody had a carry trade on, they had to unwind. So what happened? The bond market went up, but the stock market had a mind of its own and went down for a month. A month. Look at that. Bond market went up right here. Just exploded to the upside because people are like, oh, we need the flight to quality. So now interest rates went down and then people went for the overall markets. So just keep that in mind. You're looking for that positive divergence, which you don't have yet. So you had this and you had that. Now, if you contrast that to now, you have this, and really longer term, you have straight up. You could put this on weeklies and it's more dramatic. S&P up, bonds down. Just keep in mind the S&P really hasn't moved much. You know, a 10% correction, which I've been calling for, is about 600 points. We've gone down all of 200. So if the bonds don't rally, I think you see this at 5,600. Adam, if it goes to 5,600, buy me a drink. So it's first, though. It is at support. How about on a daily? Is it oversold? Not enough. You see the lack of support right there. 57.89, another 40 points. 40 points. Just keep that in the back of your mind. All right, NDX. On the way down, worry about price support, not Fibonacci stuff and all that. Where's the support? Well, you got a little here and a little here. But if all the other indexes are going to the gap, then you got to think this is going to go to the gap. So, so I want to show you a bunch of long ideas, but I think you have to wait for positive divergence. So if you see the bonds go up or you see the transports start to outperform, so you see the transports all the way up here, let's say up 300 when the NASDAQ's down 300, or you see the Dow. If you see that up 300 when the NASDAQ's down 300, well, then you have your positive divergence. But we don't have that yet. Now, in the meantime, a heck of a lot of stocks are outperforming. And they're outperforming because they got nailed last year. The pressure is off of them. So think of it this way. Let's say you're long a lot of Apple. So what did everybody say on Tuesday? Oh, fund managers are going to mark it up on the close. They didn't. Doesn't work like that. Never works like that. Number two, does anybody look at my StockTwits account? So 56,000 followers. So what do we show on December 26th? I don't know why everybody talks about a Santa rally. There is a Santa rally prior to Santa. There. Well, let me show you. Wait, let me see where it is. December. Oh, sorry. Went the wrong way. December 26th. I posted this. There. S&P has a habit of selling off on December 28th. Plus 50-50 funds have to sell stock and buy bonds. So what was the top? December 27th, 28th. Just keep that in the back of your mind. 60.37 when I mentioned it. It's now what? 58.37. So that's why I have 56,000 followers, I think. So, I have a lot of family. Maybe it's them. But getting back to it, definitely like a number of names. So how do you find them? Well, the first thing I do is I'd look for stocks that are starting to turn. Now, when I mean starting to turn, like I said, I do not buy on the way down. So somebody asked me today, how many in your 45 years have you watched bust out by buying on the way down or shorting on the way up? Well, a lot less people try to short. So it's buying on the way down that I see more people bust out. Look what's developing on a 4-hour chart in CRSP in the inverse head and shoulders. So I like that kind of idea. So does this have anything else going for it? Is it over the 50 moving average? No. Is it over the ATR trailing stop? No. Is it over the 20? No. So beggars can't be choosers. I go to a 4-hour. And on a 4-hour, at least it's over the 20. So let's take some others. How about Trip? Well, that already looked good. Yeah, we were long it. How about Starbulk Shipping Company? Over the 20. So the first thing I do is try to take every stock that got killed last year at the minimum for the last quarter, and then find which ones have gotten over their 20 moving average on a 4-hour. At least they're over something. Now, just to let you know, and I couldn't find it, I did something because TG, Allison, we all have, Roggy, all have different moving averages we use. But all of us agree you call it, it's stacked above the moving averages. So if you see the moving averages, 50 of them, and it's above all of them, that's what you're looking for. But beggars can't be choosers at the moment. And what do I mean by that? You're looking for what's gotten at least over something, like a 20. So the first stop for me is you could go into this. Now, you could go into the ones I showed you, and I'll show you. We'll just take the ones that I shared, December 31st longs. But all we're going to do in here, we're going to take off everything. Except the 20 moving average. That's it. And we're doing a 4-hour. See the 4-hour? That's all we're doing. 20 moving average. So, no, I'm not watching the YouTube chat. I hope it's not bad. So, I don't know how to watch it. So, in there. But this is the way I look at it. I look at this. These are the ones that have already reclaimed their 20 moving average. So, I'd start with those. Even Scorpio, remember we got out earlier because the whole market pulled down everything. I'd start with these. So you got the Papa John's up there. Like I said, tax law selling plus Super Bowl effect. So that's why I like pizza and DP and Domino's and pizza. So TripAdvisor's already above it. The shippers are already above it. Some biotech stocks are above it. So I'd start with those. I'd also watch the big biotechs. If the big biotechs go down, then I'm not chasing the cheaper biotechs. So just keep that in mind. So I hope that all helps. Everybody have a nice day, and I'll talk to you later.